And for more on this, we are joined this morning by CBS News business analyst Jill Schlesinger. Jill, thank you so much for being with us.
Good morning.
I want to start with going back maybe 6 days or a week at this point. It seems like this banking crisis really came as a surprise to so many people. How did the collapse of one institution in California lead to the potential collapse of the entire banking system?
Christina just mentioned a core concept in banking and finance, and that is confidence. And when we look at one situation, it's kind of easy to explain it. So we say, oh, Silicon Valley Bank, they did a lot of business with technology, they loaded up on long-dated bonds. But the reality is, the way this moves from one institution to another is that people get spooked. We lose our confidence. And we then say, what other banks were like Silicon Valley Bank? What's going on there? And you kind of lift up the hood and you check it out. To be clear, for anyone watching right now, if you have less than $250,000 in an FDIC-insured institution, you are fine. And even for those with more than $250,000, perhaps if your institution comes under trouble, there could be a rescue. It's not explicit, but I think there's some implicit guarantees that are floating around out there.
So there are now 4 banks we're seeing in crisis, and while they each have their own problems, did any of them have any singular point in common?
I think what this really does make us look at is what happens when interest rates are really low for a really long time. So if you look at pre-pandemic, interest rates environment generally pretty low. They went even lower amid the pandemic. Remember, we were at 0% interest. And what that does is it encourages risk-taking. Think of it this way. When we saw people getting stimulus checks, or you were piling up savings during the pandemic, people said, well, why would I want to put that money in a 0% checking or savings account? And then many people said, oh, well, maybe I'll buy crypto or a meme stock. And it encourages risk-taking because you're not getting interest elsewhere. That happens at an institutional level at banks. I can't get interest by keeping my money in cash. I'll buy longer-dated treasuries. OK, well, what happens when interest rates rise? All of a sudden, that risk exposure is on steroids. And what we have seen across all of these institutions is a commonality. This is what happens when the Fed raises rates very quickly. They're sort of slamming the brakes on, and all of a sudden, someone's going through the windshield. And the someone are these banks that took the most risk.
Well, given all of that, I mean, the Fed is going to be meeting later on next week, and they're going to be making a big decision. What do you think is going to happen out of that?
When you talk to economists, they're sort of split. Half of them are saying they're going to be pausing their interest hikes because there's so much systematic risk right now. But I would say, another half that say they're probably going to raise by 1/4 percentage point. Inflation remains high. And from the Fed's perspective, if they just sort of say 1/4 percentage point, it's like hitting the golf ball straight down the fairway. It's not an eccentric thing to consider that we're raising rates to fight inflation. We don't want to necessarily signal to the whole world that we're so freaked out that we're going to pause on rates. But again, it's 50-50. And I think it's going to be interesting to see that press conference with Jerome Powell after the decision.
Quickly, is this the end?
The end of what?
You won't see any more.
I can't say that. We're in the eye of the storm. And what I really do think is that there's a lot of negotiations going on this weekend to sell banking assets and banks themselves.
All right. Jill Schlesinger, we thank you.
Thank you.